This is Vanessa Chin. I'm the Senior Client Advisor at Market Matters. Now, I'll be taking you guys through today, along with James, to obviously kick off today's Market Matters webinar. Now, we're going to be talking about end of financial year and looking in particular at our view on the key markets. Now, let's just get this thing rolling. Hopefully, you're all settled in. Okay, so the topics we're going to cover today, obviously there's a few on the list there. Now, what we're going to be looking at is, are the markets going to be continuing to do as well as they are? Obviously, we're going to be looking at gold as well. We're also going to be looking at oil and see what's going on there. Also, we'll be looking at any weaknesses in oil, anything, what we expect in terms of things to come and opportunities. And we'll also be touching on something that's quite new to us. We're quite pleased to announce something called the Market Matters Income Portfolio. This is a new addition to the portfolio, which we'll touch on later. And of course, at the end of the webcast, we'll be doing a question and answers. So feel free to type in your questions in that little chat box over there on the right-hand corner. We'll try to address them as soon as possible when we get to that stage. Now, just a little bit about James. I'm sure everybody knows James is our primary contributor, but he also is a senior advisor over at Shaw and Partners. So he if you have a look at the information there, there's a lot of credibility under his name, and he does a lot of the reports for Market Matters. So if in case you were curious, he's the one that does all the reports, and we'll be speaking with James throughout today's presentation. Now, just a little bit of a disclaimer, guys. Now, just bear in mind, Market Matters is obviously of general advice only. So by no means should you consider any of this information that you hear today of a personal nature. So make sure that if you do take on any recommendations, conceive that in a general advice only nature. Okay, so let's get the whole thing started. Let's take a look at the first slide here. Now, we're looking at the U.S. markets. We'll take a look at the big picture. Now, U.S. markets have remained bullish, very resilient. So, James, what's your longer take on some of the very interesting statistics that we see on the screen here?
Yeah, thanks, Vanessa, and thanks everyone out there. I just wanted to start by putting some of our bigger picture views up. We've given a presentation in the last couple of weeks around what's happening in the U.S. market, about the history in terms of bull and bear markets and the sort of period we're in at the moment. You can see that the US S&P 500 based out after the GFC around 667 points. It seems a long way ago. We're now trading up around the 2,400 mark on the S&P 500. So it's we're up 250% in the market, which is a very, very impressive run up indeed. What we're looking for now is we're saying it's a mature stage of a bull market. And I've got a slide coming up very shortly around what bull and bear markets typically look like. So what we're, right now we're positioning for higher levels, but I think if you've been getting our reports over recent times, you'll know that we are looking for a deeper correction in time. So I guess, Vanessa, the short-term thematic is higher before we go lower in the medium term. In the very short term, and when I'm speaking about very short term in weeks, and there's a chart coming up very shortly around that, we are looking for a correction in the US market, a 5% correction, which we use as a buying opportunity.
Okay, great. So let's move on to the next one. Now, history. Now, why do we bother looking at history, and do you think it always repeats itself? So more importantly, how do we use history in terms of positioning our portfolio or positioning ourselves moving forward?
I guess we just simply use it as a guide. So, I do a lot of work looking around seasonality, looking about statistics in the market. And right now we're in the second longest bull market in history. We had a really long one between 87 and 2000, 13 years. The market was up 582%. So right now we're in the second longest in duration. It's a bit over 8 years. We're up around 250% over in the US. So it doesn't mean the market right now is going to turn and is going to drop substantially. But what it does mean, it means that we need to be conscious of the fact that we have had those 8 years of bull market. History shows that bull markets typically last somewhere around that 4-year mark. So there's been a few bull markets in the choppy parts of the early part of the century. Yep. But if you strip out that volatility in the data, it lasts around 4 years. So we're about twice the normal length of bull market, or time in the bull market. So that's something we've got to be very conscious of.
Okay. Now, why is managing downside so important? Now, if anybody over here actually follows any newsletters or have had subscriptions to others in the past, you probably noticed that majority of the time they're very bullish. You know, a lot of newsletters out there tend to focus on profits, and they kind of downplay or don't put enough attention towards the downside risk. So let's just explain our thoughts on this. There's a bit of an interesting chart here. Now, James, can you give us a quick run through on this?
Yeah, it's a quick look around why it's really important to manage the downside. So, when you lose money, it takes a lot. The returns that you need to achieve going forward are a lot more substantial than if you protect your capital in a weak market. So to give you a clear example of that, if you drop 50% of your money, you need to make 100% of your money to get back to break even.
That's right.
So it's really important, and this is, I guess, one of the areas that Market Matters differentiates itself from others is we manage a real portfolio. We don't bury the losers. We own up to the losers. Of course, we're going to have stocks that don't go or don't turn out to be what we expect them to be, and we'll cut those stocks, and we'll outline the reasons why we're cutting those stocks. But a lot out there bury the losers and focus on the winners. But it's really important to manage the downside, and that chart there's just a quick review of why that is important. And it's really important for the longer term returns that we're trying to achieve.
Okay, no, that's great.
I don't want to focus too heavily on the next chart. It's just around it. It's sort of the reverse of the table that we put in earlier, and looks at bear markets. So when bear markets happen, and the typical decline we see in a bear market. So a bear market happens pretty much every 2.6 years. But if you strip out the volatility in the data in the early part of the century, then you probably get around every 5 years. And the typical decline in a bear market is around 35%. And it happens over about a 10-month period. So bear markets don't happen over. We're not talking GFC. The GFC was a big anomaly. A bear market is defined as a drop greater than 20%. So right now we haven't had that in 8 years, that's not typical. Generally we have it about every 5 years. So we're well overdue for a 20% correction. But I think it's really important to say that that's where opportunities come up. It shouldn't be a time for you to run away from the market, because declines of that nature are generally short and sharp. So we're not saying it's around the corner or it's happening in the next week or next month, but it is something to be very conscious of.
Okay, that's great. Now let's take a look at the short term. Obviously, let's start off with the U.S. markets. James, what's your short term view on the U.S.?
The U.S. has been really resilient, and you look domestically here in Australia, we've been weak relative to the US. In May, the US market was up about 1.2%. We were down about 3.3%. So there's about 4.5% outperformance in the US. So it has been really resilient. It's been really resilient because of probably the composition of the market. The tech stocks have been doing particularly well. There's been a lot of money flowing to the tech stocks. Passive investing, that's what I mean by that, is index investing. So ETFs that track an index have been getting a lot of fund flow, and they simply replicate the market. So I think there's a few reasons why the US market has held up relative to other global markets. But at this stage, in the very short term, where I think we're on the precipice of a 5% correction over there, not the start of something more sinister. So if you get a 5% correction in the US, we'd be looking to buy it. So right now we're sitting in 15% cash in the Market Matters portfolio. We may move to around 20% cash, looking to buy that correction that we think is forthcoming in the short term.
Okay, great. So now let's look at something that probably most of us are interested in. Now let's look at the ASX 200 or the Aussie markets. Now we're having a pretty ugly day today, but James, what's your take at the moment?
Yeah, we're getting smacked today.
Yes.
Down around 70, 80 points when I left the desk. So right now we're targeting around 55.50 on the ASX in the short term. I think we'll have probably a week or so of weakness here. Yesterday was a really weak day, and not the point decline or the percentage decline that we're seeing today, but the composition or the strength of the underlying market was really weak yesterday. We tried to rally early. There was, we were hit by a little bit of negative news. There was a bank downgrade after market, etc. So the internals of the market yesterday looked weak, and we've gone on with that follow-through selling today. So I think, May, June is the weakest period in the market seasonally. There's a chart coming up around seasonality.
Yep.
July is one of the best months in the market. So we're positioning a little bit more cautiously up until the end of June, but we'll get more bullish the market come early July, and that's seasonality points to that. The charts are pointing to that, and I don't think this is the start of a rout in the market, given cash levels remain pretty high. So cash levels are high, caution is high, and that's why we'll be buying this weakness rather than selling it.
Okay, so as you've been talking about seasonality in the reports, now obviously everybody must be sick of hearing about the May weakness, but as we reach the end of financial year, what does that suggest for us now, James?
Yeah, it's a pretty annoying catchphrase to sell in May and go away, but it's been getting a lot of airtime, and the more airtime something gets, the more attention something gets. It becomes sort of a self-fulfilling self-fulfilling thing in the market. So we've certainly seen that in May. June's been a pretty weak month as well. So as I said, we're tracking the line on the chart above there. So the orange line is how we're tracking in 2017. The white line is going back in time, so the seasonal performance of the market going back in time. So that's what we typically flow, but you can clearly see July. July is a really good month for equities. It's a really good month for the banks in particular. Seasonal weakness in the resources typically play out into the back end of June. So this weakness we're seeing in the resources is pretty well known from a seasonal perspective. So July, again, is a positive period for those guys.
Okay, great. So now let's just take a look about gold. You might have, we've been talking about gold quite a bit in the past couple of months. Now, just breaking it down, we do own Newcrest, and we've talked about buying Regis or Regis Resources as well as Evolution Mining again. Now, on all three of those stocks, we've actually had some great trades in the past year. So, James, what's your take on gold right now? Are we buyers or are we sellers?
A little bit 50-50, but if I, sitting on one side, I'd be bearish gold in the very near term. I think the US dollar is a really big determinant of what happens to the gold price.
Right.
The US dollar is oversold at the moment. I think we'll get short-term upside in the US dollar, and that'll put a little bit of pressure on gold. So, from a technical standpoint, I'll be targeting probably down at $1,200 for gold. We have Newcrest, but it's only a small position in the portfolio, and we'll add to our gold position into weakness rather than sell Newcrest now and add to it later. It's we might be, if we're wrong, we've got Newcrest there and we've got a small position in Newcrest, but I think we'll probably see further weakness in gold, and that's just the US dollar on the screen. That you can see the US dollar index, which measures the dollar against its major trading partners. You can clearly see we've been negative the US dollar throughout this year, and it shapes some of our investment decisions. So right now, I think we've medium term, the US dollar is probably going to drift sideways from here, but I think in the very short term, we'll get a short-term bounce in gold, and that'll put some pressure on. A short-term bounce in the US dollar, and that should put some pressure on gold in the short term.
Okay, great. Now, I guess next thing, let's talk about oil. Obviously, it's quite weak, as we all know. Now, the oil process. Now, we've owned Origin towards the end of last year, and James, you've written a lot about Santos in the past couple of years. So, what's your take at the moment, and how should our investors be positioned in oil?
Yeah, we've got in our 2017 outlook piece put out early on in the year. We talked about oil being in the range between $40 and $60 a barrel through calendar year 17. At the moment, it's been playing out as predicted. We're down at the lower extremity of that range, so 43.54 it closed at overnight. So, look, I'm negative oil still. I don't think there's any signs that oil is going to bounce here. We don't have any energy stocks in the portfolio other than the diversified miner in BHP. So, I sort of think that oil is a tough one at the moment, but there's no signs that we've seen a base in that commodity just yet. So I'd be avoiding energy stocks, Origin, Santos, and the like. You talked about Santos and me speaking a lot about Santos.
Yes.
There's a lot of reasons to dislike Santos. It's a highly leveraged play on the oil price. I think management have done some pretty stupid things in the past, for want of a better word. They had a good takeover. They've raised capital at low levels. They had a takeover offer at higher levels. They've done, and I just don't think the quality of their balance sheet, I don't think the quality of their assets stand up. So Santos, I don't like. At this stage, I don't like any of the oil companies in the short term.
Okay. Now let's get on to actually some of the stocks that we actually hold in the portfolio, and I'm sure some of you might hold them as well. Now BHP, first of all, why do we hold it? It's obviously getting a bit hit today as well.
Yeah, it is. There's no doubt about that. Which is, the seasonality from a seasonality perspective, it doesn't come as a huge surprise that BHP is getting hit. And you might say, well, why are you holding it? There's a couple of reasons why, and I'll go on to the next slide. But from a shorter term perspective, we may look to add to our position in BHP at the back end of June. Right now, we're around $22.20. We're comfortable with our position there, but we may look to add to it. I think the reasons why you hold BHP in the portfolio, I'll just so that you can get a feeling for where we have been and where we are at the moment. We've missed all the pain in BHP. We've had some profitable trades in it over the last 12 months. We bought it near the lows, around $14, $15, and we've had some really good positional trades in BHP. So we think it's a trading vehicle rather than an investing vehicle. It's not something that we're sitting there holding it for longer term. And one of the reasons for that is the discrepancy, the inability of the market to predict commodity prices. I know I've just talked about oil price in a range, etc. But there's so much variance in the market around commodity price forecasts. So
that's right.
If you look on the screen there, you've got you've got three of the bulge bracket brokers: UBS, Goldman Sachs, Credit Suisse. Their FY17 numbers are pretty close because obviously we're coming up to the end of FY17. BHP is on a financial year. Rio down the corner is on a calendar year numbers. But if you go out there to FY19 in BHP, there's a 34% variance. If you look at Rio's numbers, EPS, there's a 66% variance. So it depends if you're bullish or bearish on commodity prices. So particularly iron ore. Iron ore I'm more neutral on. So I think we talk about Rio and Fortescue very shortly. But one of the other things we look at is the divergence between the emerging markets and BHP share price. So they generally follow each other pretty closely, which is understandable given BHP supplies a lot of the product that goes into emerging markets for buildings and developments, etc. A lot of the raw materials that are required by emerging markets. So that divergence to me looks like an opportunity. I think BHP goes higher from here. I don't know what it's going to do tomorrow or the next day. But in the next couple of months, I think BHP goes higher.
Okay, and you did write about Citi downgrading the stock earlier this week. Now, does that concern you when that happens? Sorry.
Yeah, Citi downgraded all their iron ore forecasts out for the next 3 years. So it had the most impact on Fortescue. So they cut their price target. They had a hold on about a $5.90 price target. They cut it down to a $3.90 price target. They've got a buy in BHP and a buy on Rio, but they just lowered their price targets because of their lower expectations for iron ore. I think the horse has bolted in it. So these guys were more positive at $7 and now getting bearish when Fortescue is trading around the 460 mark. So we bought Fortescue last week, about 10 days ago. We paid $466.5 for it. It was it's a high risk contrarian trade. But I think the market's now getting they're downgrading earnings expectations on the back of weaker iron ore prices. But the price, Fortescue's already priced that in. There's a big gap between Fortescue's earnings and where the share price is trading at now. So the market is always right. The pricing of the stock is always right. And where analysts are typically late to downgrade, they're late to upgrade, etc. So in my view, they're late to downgrade and you should be buying this weakness and heightened levels of negativity towards Fortescue. It's a high-risk trade, though. It's a high-risk trade.
Okay.
Similar situation in Rio. So, iron ore prices have been starting to get downgraded by analysts, and that's having a negative impact on earnings of not only of the miners, but also the ASX, of the market generally. So we've had earnings declines in recent weeks. So in aggregate, earnings expectations are going backwards, and that's why the Australian market is struggling at this stage. It's not new news though. So you tweak your iron ore price forecast, and that has a big bearing on earnings. That's well and truly in the market for mine. So it's a similar situation with Rio, BHP, and Fortescue, where the price of the stock has already come down, preempting a downgrade in earnings. The the earnings are getting downgraded
Right.
as we anticipate. So if you get some short-term weakness, then you should be buying that short-term weakness in our view. But you keep an open mind. So
Right.
if we're wrong, we'll put our hand up and cut the position and realise we're wrong and conserve capital. But at this stage, we're comfortable with our $70 price target on Rio.
Right, that's great. Okay, now let's have a look at income. Now, obviously, everybody's after dividends. Everybody likes income to come in. Now, for those of you that weren't at the seminar that we actually held our first seminar ever at the end of May, so last month. That was held at the Four Seasons in Sydney. Now, that was a great success. But during that time, for those of you who weren't at the seminar, we did actually introduce something called the income report, which is something that we're actually going to be adding onto our service, our existing platinum service. Now, this will be a new addition, and frankly, we do like to take on board feedback of clients, and this has been requested quite often by a lot of the clients that we've spoken to over the years. So we have actually put that into effect, and we will actually see the launch of that proudly at the start of the new financial year. So let's talk a little bit more about that. James, what's the approach going to be? Is it going to be more passive, more active? What sort of things is it going to hold?
Yeah, thanks, Vanessa. It will be good. So it'll start in the new financial year. There'll be an income report released every Wednesday. So it'll have the income portfolio. It'll have some discussion around what's happening in terms of income-related securities that are listed on the ASX. And when I talk about income securities, I'm meaning high-yielding stocks. I'm meaning listed hybrids, as you see on the screen there. You've got a lot of the financial hybrids, or all of the financial hybrids on the ASX there. And it'll also look at high-yielding ETFs and potentially LICs, so listed investment companies that have got a focus on yield. So we're going to go out there and scour the ASX, finding the best income opportunities, not limited to stock, not solely limited to hybrids or other income-producing listed assets. It's going to be a combination of the two, and it's not simply going to hold the big four banks and say Sydney Airports and Transurban, etc. So we're going to have an active approach to it, and take into consideration some of our bigger picture themes. So it's going to be really tricky out there on the income side in the next 12 to 18 months, in our view. And I think I think the good times have been had in income. The obvious income stocks, so the Sydney Airports, the Westfields, the like. I think those have run their course. So you're going to have to be a little bit more intelligent around your positioning to income securities. So like if you think about financial hybrids, they trade at a margin over and above the bank bill swap rate. So as interest rates start to go up globally, and they will go up globally, the market is probably grappling with that fact at the moment, but they will go up globally. Then these tend to do okay. So there's things in there that you can get 6% yield to first call. That's good, but you don't want to have your whole portfolio concentrated in that area. So we'll be looking at these, and we'll be looking at other areas, and we'll be writing about them weekly. So if there's a new hybrid that's come to market, we'll be writing about that. If there's a new income stock that we like to look at, we'll be writing about that. And we'll be packaging it up and putting it in an actual portfolio that we put out to subscribers, similar to what we do with the Market Matters equity portfolio. Okay, so just to clarify a few things, we're just wanting to emphasize, a lot of people who go for income stocks, they tend to assume that it's a more buy and hold kind of thing. So I'm assuming, James, that ours will be a little bit different, mix things around a bit. Yeah, it is. It's going to be optimizing the portfolio by being active around it. So I think the buy and hold approach is probably dead. I think the market's too volatile for that. I think the market's going to be too volatile for it going forward. You've got to have a really good grasp on the underlying earnings of the income security you're buying, whether it's the earnings of the underlying bank in a financial hybrid, or the earnings of a fund manager that we're buying for because it's got really good dividend yield, or there's no point buying something that is paying out more than they're earning in dividends. It's not going to be sustainable. So you've got to have a real focus on the earnings side of it as well as the income side, and preferably we're not just looking solely at the yield they're producing now. We're also looking at the yield that they're likely to produce in 12, 24, 36 months down the track. So you've got to have a handle on earnings and the growth in those earnings and what risk is likely around those future earnings. So look, it's exciting. It'll be something that's going to be not your typical income portfolio.
Yeah.
And as you said, it's going to be included in the Platinum service, so it's all included in your normal Market Matters subscription.
Oh, that's great. That's great.
So that is on the screen there. I'm just looking at the CBA PF. So this is a CBA income security. It pays a yield around 6% at the moment. So yield to first call date. It's got 4.8 years till that first call date. So when you're looking at hybrids, you need to look at the maturity dates. You need to look at obviously the underlying issuer. You need to look at the margin over swap. But I think the call date's probably one of the really key things. So a longer dated securities are going to be more volatile, but they're probably going to pay you a higher running yield or a higher yield to call.
Yep.
Shorter dated securities, you get lower return, but you get lower volatility. Like all these things have done pretty well in recent times. We're starting to get this week and last week, there started to be some selling in these things. So there's some opportunities about in the income space, in my view.
Okay.
And then the chart here is just around corporate debt as opposed to financial hybrids. Obviously, the market is dominated by bank hybrids, but there's a lot of corporate debt securities out there as well. So we're going to talk about the differences between, say, Crown HA and Crown HB. Why does Crown HB pay you a yield to call of 7%, and the HA only pays you 4.7% yield to call? So it's around the maturity and their debt, the debt maturity profile that they've got. They've got a lot of senior debt that needs to be repaid prior to the redemption of the HBs. So there's some. We'll write about those things in this income report.
Okay, that's great.
Stocks in the income report as well will also feature. So I don't want to have. We're talking about income now, but we're also talking about we want to have a portfolio that the income is going to grow over time. So CNI is a stock that I have in some client portfolios. It's an income security. It's a property funds management business. But you think of something like that, and it's paying right now. It's paying a yield of around 6.5% in FY17. That ticks up to about 7.1% in FY18 on my expectations, and 7.2% in FY19. It's about 40% franked, so you don't get that full benefit of franking. But still, you've got it's an income security that's got some growth in earnings as well. So therefore, it'll have some growth in dividends going forward.
Great.
HFA is another one. It's a fund manager. This is a really high yielding stock, but it's got sustainable earnings along with it. So in FY17 on my numbers, it'll be yielding around 9%. Going up to near 11% in FY18. So these are really high yielding sort of equities with that underlying quality of earnings as well. So they're just a type of stocks that we're going to be putting in the income portfolio.
Okay, that's great. And now QBE, that's a hot topic today. Obviously, now we also hold QBE in the Market Matters portfolio. Obviously, it's a stock that's had a bit of a downgrade today. It's down around 8%. We're still showing some good profits, however, but James, what are we going to do following the downgrade?
Yeah, I wanted to put this in here today just to really emphasise our approach. So, our approach isn't about highlighting all our winners and burying our losers. Our approach is an active approach. It's an approach that we talk about things that don't go right in the market. And QBE, this is a good stock in our portfolio. We bought it when no one really wanted to buy it, when it was trading around the mid-10s.
Right.
We're up 20-odd% in it. We're up, closer to 30%.
Yes.
We've had a downgrade today, which obviously isn't it's not a positive thing. If you think about the downgrade, it's about a 6% downgrade from an earnings point of view. So I can bear that. That doesn't concern me as much as probably the market's perception of it. So the market started to like QBE because it had this. It had the joint benefit of higher US interest rates, so its investment returns were going to improve, and it also had an improving earnings mix from its insurance business. And what I mean by that is that insurance premiums in the US, commercial premiums in the US have been going down for a long time.
Yes.
They're still declining, but the decline is getting less, and that they're starting to improve. So, you've had a number of years where you've had a lot of years where QBE's had either investment returns that are declining or commercial premiums declining. or one of each. And
Okay.
right now I think we're in a period where they're going to have the benefit of both. So insurance premiums improving, investment returns improving. They did guide to good investment returns. They've said that they're going to be at the high end of the 2.5% to 3% range that they'd previously guided to.
Okay.
So that's a positive. They've got a higher claims experience in their emerging markets book. So in simple terms, they've had more claims in the emerging markets book than they thought they would, and that's got about a 6% downgrade to earnings. It's short term, but my only concern here, and we're holding it, but we're going to review it in the next day or so, is around what the market will do here. QBE had a history of overpromising, under-delivering. They've improved that in the last 18 months or so, but this is sort of 3 steps forward, 1 step backward. So I'm a little bit 50-50 on whether to continue to hold it or not. I think longer term and medium term, this is going to be a good play. I just think in the short term, we might be able to get a better entry back into it at lower levels, but we'll make the call in the coming days.
Okay, so we'll watch out for that. Now, let's just have a look at our portfolio positioning moving forward. This is actually in relation to the actual Market Matters portfolio. Meanwhile, if anybody is coming up with any questions, feel free to start typing them up. We'll be addressing them quite soon. But yeah, until then, James, what are your thoughts on our portfolio moving forward?
So right now, just to give an overarching view, we've got 15% cash. We've got a large position in insurance, which doesn't look good today, to be honest with you. But Suncorp and QBE have been 2 reasonably sized positions in our portfolio. They've done incredibly well. So we're up in we're 20% plus profit on both of those positions, even though they don't look as good in the market today. The reason we're so long insurance is the 2 thematics that I talked about just before around improving premiums, so improving earnings, and then a better macro backdrop. So interest rates going higher, it's going to support their investment returns, etc. And in terms of Suncorp, as well as QBE, they've got excess capital on their balance sheet. So those reserve releases. So if you think about QBE had problems in the years gone by because they bought a lot of businesses, didn't understand the insurance book that they were building or the book of liabilities effectively that they were buying, and they under-provisioned for them. So they then, a couple of years ago, they went and increased those provisions. They took a hit to their earnings to do that. And now we have a situation where they're probably over-provisioned and we can get some reserve releases coming through to the P&L. So same with Suncorp. So Suncorp's got excess capital on the balance sheet. They've got excess franking credits. The earnings environment's improving for them. The macro backdrop's improving for them. So we like insurance in that regard. So we have a high conviction approach. So we're not about going out there and buying 20 different stocks. We've got a high conviction approach. We enact our views on the markets through the stocks we like. And we'll make the calls and we'll go to high cash levels if we need to. We'll be fully invested if we need to. But again, we won't be afraid of making those big calls. Materials, for us, we've got 20% of the portfolio materials right now. That is incredibly high for us. We didn't have any material stocks for a number of years, and we've had a few really good trading positions in them in the last 12 months, and we continue to view them as trading positions in QBE.
Okay, well that's great.
Yeah, you look at the banks are interesting here. So we've started to build back a position up in the banks. We bought CBA below $80. We sold it recently around the 87 mark, so we've made a good turn on that. And as I said, Fortescue, I think the market's pretty negative on it, and I think that's overshot to the downside. CYBG is the old Clydesdale. That's got a really high cost to income ratio. So I think it's a really it's a self-help story as well as a story on an improving UK economy, which despite Brexit I think is doing okay. So we like CYB as well. Rising interest rates are going to be a benefit to that as well.
Okay, that's great. So now let's move on to the next one. Now here's just a little bit of a summary. James, did you want to take us through a bit of a summary before we go on to the Q&As?
Yeah, so markets. I don't want to scare a lot of people. The markets are in that mature stages of a bull market, and I think it's really important to be conscious of it. You don't want to put your head in the sand. You want to be you want to think about these things, what's happened historically, and use that to guide your thinking going forward. So I think that's an important thing. I think the markets will, this year on the ASX 200, I think we'll see the market above 6,000 in 2017 before we then need to be getting cautious. Fund managers, the market generally is too cautious at the moment. Cash levels are really high. So cash levels across the board are high. When fund managers in the market generally is cautious, then the market typically moves in the direction of most pain. And right at the moment, the direction of most pain is probably up. So, this short-term June sell-off, I think will play its course into early July. I think the market will rally from here up into the 6,000 mark. Then we should be starting to get a little bit cautious on it. But again, keep an open mind is what we really think here at Market Matters. And weakness at the moment is providing an opportunity for us. But again, an open mind and be reasonably active around your positioning. And we'll be able to guide you through the risks that we see in the market.
Okay, great. So let's move over. So now we're going to start touching on some of the questions that some of you guys have sent through. Now, one of the first ones that I actually got through here was, what has your strike rate been in the past 12 months? Now, I'll get James to elaborate on that. But first of all, just clarify a few things. For those of you who are wondering, you might have attended a few webinars in the past. You may even have a few other, subscriptions. Here's a bit of a point of difference to consider. Now, Market Matters is very different in the sense that we actually own a portfolio. So anything that James touched on that is in regards to our portfolio, it means that we actually have a real portfolio. We're actually investing in that stock. So what that means is we're not actually just hiring analysts to put out buy recommendations every week. We're not just waiting for people to say, oh, every market is a bullish market. We're actually in the game with our investors. So clients who actually invest in our recommendations are actually investing alongside what we are actually doing. And that's why it's very transparent. When we have a strike rate, when we have actually information that we publish in terms of our returns, they're real returns. So whenever we put a recommendation out, it's a real one. We'll tell you how much we're allocating in terms of a percentage. We'll tell you what price we're buying under. If it exceeds that price target, we'll most likely not be able to buy it. Same as you if you miss that as well. So that, just bearing that in mind, with the strike rate, we've actually done 43 open and closed positions in the past 18 months. So 31 of those have been in the positives. Now that's a 72% strike rate, but it's a real strike rate. So it's not based on a hypothetical portfolio with 200 stocks. It's a real portfolio that we've got. So that's one of the main questions that I just wanted to address real quick. James, did you want to touch on anything about our strike rate there and how well we've gone?
No, you look at when I look at the performance of a portfolio, you want to look at the volatility in returns as well. So you want to have a good hit rate, but you don't want to be taking all profits after 2 or 3% increases and losses are on the large side. So we've got a really positive average win versus average loss as well. So there's some, it's done well over the last few years, that's for sure.
Okay, great. Now we've got one more question here that's popped up. Now we've got a question about healthcare. In particular, we've got Cochlear and CSL. Now, James, have you got any insight on those two stocks there, as well as the industry?
Yeah, I mean, the market's weak today, so healthcare is performing really well. I think there's a couple of areas in the healthcare space you've got to be a little bit cautious on at the moment. CSL, we've traded that this year profitably. I wish we still hold it. We don't. We sold it out for a good profit, but I struggle to get my head around the valuation in CSL. I know it's been an absolutely screaming success story. I think it's an incredibly well-run company, etc., etc. Right now, I'd be reluctant to go in there and buy it simply from a valuation point of view, and simply because the market is really long that stock. All it would take is one sort of hiccup, and that stock will sell off pretty dramatically. We saw it a few months ago. The stock was trading around that $90 mark after an earnings downgrade. They then come out a few months later and increase their earnings or increase their guidance, and the stock got bought up again. So, to me, I'd be reluctant to go out there and buy CSL. I note that it's incredibly strong company, well run, etc. So okay. I think the other thing in healthcare that is worth noting is around the hospital operators. So HealthScope, we're looking to buy some HealthScope around that $2 mark.
Okay.
And it just doesn't sit right with me around, the government's looking to fill revenue holes. And I think the healthcare area of the market or healthcare companies are a potential avenue that they could go and do that with. So I'll be a little bit cautious. We don't have any healthcare in the portfolio at the moment.
Okay, great. Now we'll move on to another question. I think that will be something that quite a few people might relate to. Now the question reads, now I run a self-managed super fund, but the markets are correcting so much that I don't want to be catching a falling knife. Now, whether I should hold on or should wait to start investing, is the question. So I'm assuming there, just to recap that, I'm assuming, he's got a self-managed super fund, and he's looking at whether or not it's a good time to actually get in now or start following recommendations now, or watch the markets now that it is taking a dip. So James, what are your thoughts on that? A lot of people are a bit hesitant, if the market's taken a bit of a dip, or if it's due to take a bit of a dip, they're a bit wary to actually get involved in the markets, thinking that they might be catching a falling knife.
Yeah, it's a pretty good, it's a reasonable assumption to have. I think we're going out there targeting a reasonable correction in the markets, but we're not there yet. So in my view, cash levels are too high for a meaningful decline to happen.
Mm-hmm.
So I don't think we're about to go into a meaningful decline. I think we're probably 12 months out from that happening. So for me, I think that there's still opportunities in this market. I think you continue to view the market as weakness as a buying opportunity.
Right.
Maintain cash positions. And I mean, we in the portfolios that we manage, we also overlay something. We utilize options to hedge portfolios and a lot of other products out there. And over time, we'll start writing about these. So
right.
Products that can benefit from declining market, for instance. So if we've got the view that the market has peaked and we're likely to see a protracted sell-off in the market,
yes,
then we're going to be writing about things that we can benefit from that decline in the market. So, I look at our portfolio, the portfolios we run. In May, the market was down 3%. We're sort of flat on the month, and that's what really I like about. You look at a portfolio in weak periods rather than strong periods. Anyone can make money on the way up.
Yep.
But it's those weak periods that really give you a good indication of your ability or otherwise.
So generally speaking, there is still opportunity, even though the markets are heading
definitely.
Likely
so I mean,
south.
yeah, exactly. You've just got to be selective in the sectors you look at. So I think there's opportunity. Like the banks have copped a bit of a battering in the last little while. 11% off the 12% down in the May-June period. That's pretty typical. Banks are seasonally weak in that period. Since the GFC, I think CBA has corrected around 11%. On average over that period. So, Look, I don't want to. I think the market is still in a reasonably good place. I think the catalyst is going to be in 12 to 18 months when interest rates start to rise more quickly than anyone anticipates.
Sure. Okay. Well, if there's no more questions that I can actually see here, then we might just move on to the next slide there. So now, okay. So obviously, it's the end of financial year. For those of you still here, now end of financial year. Obviously now. Based on the fact that James has given us his outlook for the year, we're still looking for opportunities. It's still a good time to come on board. I'm sure some of you might have been on a trial, if not most of you. You might have tried a 2-week trial with us and have been kind of looking at the markets, wondering, okay, well, is this a good time or should I wait a little bit longer? You've had your questions answered there and then. There are industries we're still looking at, gold. We're still looking at, certain particular, stocks that we've got on the watch list. So there's always opportunity to be made. Now, being the end of financial year, everyone's doing deals, so we're not going to say that we're not. If you've been considering it all, we're happy to say that we're doing a $241 discount off our 1-year subscription, as well as a 2-year one for $1,397. So obviously the retail price is actually $1,238 for the 1 year. So it's great, even if you're looking for a tax deduction. Bear in mind we do have a 90-day cooling off period as well. So if you're kind of almost there, but you're still kind of thinking things through, you still want to see how things go, give us a shot. We've got a 90-day cooling off period where you can actually use a full quarter to really assess some of the alerts that we send through. Because they're real alerts, a quarter, and because we are shorter term as well, within a quarter, you'll be able to see at least more than enough buys or sells to really make up your mind and see whether or not this is really worth it for you. So for us, again, just to emphasize, the real value here in the service is the alerts. If you're an active investor or looking to be active, if you follow the alerts, there's no other way to see how well we go other than to give us a shot. So give us a call or otherwise, you've got the 1-300 number that you can always ring. Thanks so much for attending. We obviously wish you a great end of financial year. Hopefully you take advantage of some of the deals moving forward. But otherwise, thanks so much for listening in. James, is there anything else you'd like to say?
No, thanks for listening. I think the main thing is around being, markets are really dynamic at the moment. Markets are changing pretty regularly. So it's about keeping your finger on the pulse. It's about protecting what you've worked a long time to save up, and it's about getting, it's all about the returns and the process that we're putting out there. So we stand by it. We're happy with it, and we've got a lot of happy subscribers, etc. So hopefully you can become one. Thank you.
All right. Thanks so much, everyone.